Lori, were equities removed from the turmoil in the other asset classes?
I think they were a little bit this week, but frankly, I think they deserved a bit of a break after the year that we've had and the past couple of months that we've had. Look, I think investors on the equity side were also gearing up for earnings. And we were in a little bit of a holding pattern until we got to the end of the week. And financials, I mean, there was definitely interesting moves in financials today once we finally got through the kind of breakout.
I'll say, Shanali Bassick aged this morning. David Bianco, help me there, because in your research note, you say the banks are of interest, but the banks are all varied. Which kind of bank is where investment should be today?
The big banks, the ones that have sticky deposit bases, the ones that will benefit from the Fed hiking and the continued Fed hiking. So it's not comfortable to own banks if we're perhaps heading into a recession. But even if we do have a recession, this is not going to be a deflationary type of financial crisis. I think the credit costs will be well behaved and the banks will do fine.
How much are financials an idiosyncratic story versus a story of macroeconomic strength, really? Because that really was the feeling when JP Morgan came out, and over time it became something different.
Well, it's a good question. And I do think when you have, it's hard, financials are always a macro story. It's very difficult for financials not to be sensitive to the macro and purely idiosyncratic. However, what's happening in the macro situation right now is inflation and the Fed hiking. So who's the only beneficiary of interest rates going up? It's banks. Everybody else is worried about that, not just in terms of slowing economy and earnings and PE pressure, but banks benefit, at least with higher earnings from higher interest rates.
So given that backdrop, Lori, and given the fact that you said that really stocks were somewhat immune to the volatility we were seeing in other asset classes, what are we pricing in? Is there a disconnect right now between the asset classes, with stocks painting a much more sanguine picture?
Look, stocks are pricing in a recession at this point in time. I mean, we've moved beyond kind of growth scare territory, which is where we were for the first part of the year. Now we've been down around 25% from the peak or so. And your typical recession drawdown on a median basis is 27. Your average drawdown is 32. So we're kind of pricing in that short, shallow recession scenario. We're not pricing in a typical recession. We're not pricing in a severe one. We're not pricing in an extended one. But I think the good news, if we do have that short, shallow recession in the back half of the year, the equity market got a lot of that damage out of the way early.
It's asymmetric, or log normal, I should say, actually, and it's so easy to get out of the market, David Bianco, and it's so tough to get back in. I want you to go back. Lou Rukeyser, 1987. How afraid were we in 1987 after that crash? And getting in November and December before that 88 boom in the market was brutal. David, where do you find the courage to get into the market if you're afraid?
How to pick the bottoms, not an easy thing. And the 87 crash of about 35%, that's the only time the market has gone down more than it has now outside of a recession. It's not clear that we're heading.
So there's an equivalency now with 1987?
Well, no, 87 was far worse.
I'm trying to make some headlines here. Stay with me.
This has been a tough market. Lori's right. I think the equity market has largely priced a recession, a small one, but not entirely. However, we have seen how things can get worse, like 87, even when the economy was fairly okay. But you're right that there was a lot of uncertainty around interest rates, the dollar, and the global economy wasn't as important to the U.S. and the S&P back then. But the volatility we see in commodities, currencies, interest rates, the fear of what might happen to credit costs, I am not sure that we should try to pick a bottom and scoop up stocks in one fell swoop, but I do think investors should nibble.
Well, and
nibbling gives you confidence.
Nibbling where?
Well, I do like the banks for those who are the braver heart. I think some safer areas are healthcare and utilities.
Well, but Lori, I want to get to this idea of both baking in a recession, but also the Fed, and the possibility that as we see the Fed officials go into a blackout period where we're not going to hear from any of them next week, and some people might cheer, perhaps this guy. St. Louis Fed President Jim Bullard came out today and yesterday and really knocked down the idea of a 100 basis point rate hike, but did raise the specter of 4% Fed funds rates by the end of this year. Has that been priced into stocks?
I think that largely the idea that the Fed is going to be very, very aggressive in here, that's in the market. But I think markets are still struggling a little bit with the extent of the economic damage, and that's what's yet to be priced in. And I think that markets at the end of the day on the equity side, they just want to know what the path is. They want to know what the exit strategy is. They want to know how far this is going to go. They want a bit of a timeline. We're seeing some investors talking about, bad economic data points and saying, well, we're going to, we've upped the possibility that we're going to get cuts early next year. And that's telling you equity investors are willing to look very far ahead, but we need to stop giving the equity market nasty surprises.
Lori, do you understand the consumer?
I think so. I am one.
So the American consumer supposedly is strong.
Yeah.
And yet we see that they're incredibly worried, and we see that their balance sheets are getting weaker, and we're seeing their savings are getting depleted. How do you understand that in terms of the path of this economic cycle?
So I think there are two things. I think that, at the end of the day, I think we may look back at 2022 and say that this was phase 3 of the pandemic, with 2020 being the year that everything fell apart, everything happened, the health crisis hit, 2021 being the year of the initial recovery, and this year possibly ending up being the year of normalization. So I think we need to think about it in that context from the psychology perspective. And I think there's something powering consumers that we don't quite know how to model as forecasters. And I think, we've been talking about how lousy the consumer confidence data has been since I think about this time last year, and it didn't derail spending. Why is that? I think also, if you think about the consumer, we're starting this crisis from a point of strength, stronger than we've gone into past recessions. Yes, data is going to get worse, but we need to keep that in mind as well.